going to do now is we've been fortunate enough to, much that was discussed tonight had to do with 4 different industry or 4 different sectors of the market. So I'm going to introduce a panel. We're just going to get their take a little bit on John's survey and what they think is going on in the industry. So let me just introduce the panel quickly, going from across to my right. We have Michael Kane, the Managing Director for Calteus Mezzanine. Calteus focuses on the middle market needs for subordinated debt in the $10 to $75 million range. Next is Fred Helms, who's a Senior Vice President, Division Manager for U.S. Bank. U.S. Bank is the 5th largest bank in the United States and 4th in California, and very active in the senior debt space. Next is Fred is Bob Holman, who actually we just go by Bob. And Bob is the Managing Director and co-founder of Miramar Venture Partners. So Miramar invests in early and mid-stage tech companies. Right now, the 3 core tech sectors they're focused on is cloud computing, internet, and medical IT. And next to Bob is Aaron Perlmutter. Aaron is the Managing Director and co-head of corporate finance for Levine Lightman Capital Partners. Levine is one of the larger private equity funds in Southern California, actually in California, and right now they have an excess of $5 billion through 7 private equity partnerships. So you can tell it's a pretty good, diverse venture capital, private equity, senior debt, and mezzanine. So what I thought I'd do is maybe, one, we'd like this to be proactive for those that you have questions. So I'll throw a question or 2 out, and if there are a couple of other questions, we can obviously get that from the audience. So if you have a question at any time during this, just please raise your hand, and we'll make sure you get your question in. But let's start off maybe with Bob after hearing this. Bob, what market do you see as the most interesting in venture investors in 2012? Where do you see the market going for the venture space in 2012? Well, no, Bob, we purposely turned yours off. Go ahead.
First of all, I did make a promise to John. I just want to say that I disagree with everything he said. Okay, got that over. Interesting market. So from a venture standpoint right now, I think anyone who's noticed while the rest of the economy is struggling, the public markets seem to want to pay 18 times revenue for a company that's never shown profits in its life and has a ton of competition. So venture capitalists are very good at following the herd, and so I would expect that with the kind of riches that these internet and social internet models are creating, that we will continue to see venture capitalists take a hard look in that space and see where they can carve things out. I mean, Groupon is a great example of a company going from 0 to multi-billions in just a couple years. And that's not lost on VC that wants to make a couple $1 billion in a few years. And so I would anticipate things continuing to happen there. Cloud computing, big data, big area, lots going on. Anything moving from the enterprise within the firewall to outside to the cloud and all the problems that are associated with that. Huge area of opportunity. And then healthcare, probably a continued area of interest noted on John's slides. IT will be big, pharma, med device we'll see. There's a core group of investors that continue to invest there. Probably won't see a big upswing there, but nonetheless an important area for the next decade.
Thank you. Michael, one of the questions that was asked that we have presented here is, what's the difference between doing mezz for private equity groups buying companies versus non-sponsored transactions?
Thanks, Lloyd. It's the same fundamental product, which is debt that's fully subordinated junior to bank debt such as U.S. Bank, and senior to the equity. The real difference is with a private equity group like Levine, you have a professional investor, but a very efficient user of capital. So if you go back to the history of Calteus, our first fund 14 years ago was $43 million, and because of the size of that fund, we did all our deals without private equity, and have kind of, even now that we're $500 million, the majority of what we do is non-sponsored. And the reason is this: sponsors get a huge premium in the capital markets in terms of the amount of leverage and the cost of capital. Again, guys like Aaron are very efficient users of leverage. And versus entrepreneurs, which are very efficient users as well and have CFOs, however, they're going to do one transaction. They're not going to be as consistent as private equity, so there's less demand for that, or less supply of that type of capital. So many mezzanine funds focus on private equity. You can establish a relationship with a firm, again, like Aaron's, and do 2 or 3 deals a year potentially, versus having to find a given entrepreneur and doing one deal. We focus on that. Generally, the leverage is lower, the pricing's somewhat higher, and that's just a supply and demand question. But again, it's the same fundamental product, just with a slightly different spin.
Thank you. Fred, one of the things that we heard in the presentation was that as lending continues forward, everyone's looking for more of a quality company. I mean, so today, what are the attributes and what is a senior lender looking at that identifies a company that is high quality? And if I have a company, how do I know if mine's high quality?
That's a really good question, Lloyd. And I noticed that term in there as well. And quality can be relative to size, but it doesn't necessarily have to be relative to size. John, your graph shows things are a little bit better for the bigger companies. But really, a quality company is one that is profitable, right? One that has cash flow. We like that. And our primary source of repayment is cash flow. A lot of people tend to think it's collateral. We really don't own the collateral. Banks like to be repaid. The primary source of repayment is cash flow. So a nice steady history of that, a good operation, good solid management team. And then probably the third thing would be liquidity. Does the company have necessary liquidity to operate? Preferably, and liquidity can be measured with cash, marketable securities, availability on lines of credit, things like that. Do they have several months of liquidity to operate their business? I mean, those are key. Other things that we will consider, but at a lower priority, are like leverage, balance sheet or cash flow leverage. The cash flow leverage shows the ability to repay over a number of years. When a bank on a senior debt basis gets over 3 times, when we see over 3 times cash flow leverage, we get a little skittish about that. And your graphs showed that very well. Total cash flow leverage, when it gets over 4 times, we get a little uncomfortable. And basically, cash flow leverage says if the company dedicates its cash flow to repay its debt, how many years will it take to repay that debt? So those are attributes of a quality company. When we see that, we see experienced management team, and we can build a relationship with that team. That's a quality company.
Thank you. Great answer, Fred. Aaron, let's go down and let's talk again. We're talking about a company here that runs $5 billion, in excess of $5 billion. What did Levine do complete in terms of deals this last year? Did that meet your expectations? And what type of deals did you actually do in this last year?
So this past fiscal year, we'll close about 4 transactions that were new platform investments, and those would have been in the healthcare space, a franchisor, a specialty manufacturing company, and a consumer products business. And I think importantly in this environment with, as John's data shared with all of us, multiples for quality companies seem to be pushing up with capital markets and liquidity for larger businesses becoming more available. One of the focuses for us was looking at our portfolio. Once you've made an investment and once you've worked with a management team and spent time to know the business, do the due diligence, and have that management team perform over a period of time, the best form of investment for us is to reinvest in that business, looking for acquisitions. So in conjunction with the 4 platform investments that we made through our larger fund, we made 5 tuck-in acquisitions for our existing 8 platform companies.
Okay. Bob, let's go back to you. We saw on the slide that it's getting, there's kind of a shortage of cash for the companies that are $5 million and less in EBITDA. Isn't that really a space where venture capital comes in, and where do you look at companies like that? How do you look at companies like that?
Looking at the venture capital space more broadly, one of the points John made was the expectation among venture capitalists that we'll continue to see a shrinkage in the industry, right? And the industry has been changing over the years, and a lot of the money gets concentrated more and more up in the Bay Area with bigger funds. If you look at the fundraising statistics, the amount of new capital that's being raised right now by venture funds is down, and the number of funds raising it is down. And I think that's a really important, those are important statistics to watch, because the more that trend goes on, the harder it's going to be to fund smaller companies, the less than 1 million EBITDA, even the money-losing companies, certainly outside of the Bay Area, because you have a concentration of capital with fewer people who are going to want to put money to work writing larger checks. And I think John did also say that the checks that ventures writing they expect to write larger checks.
Exactly.
Yeah. So you have that happening, which is going to make it a little more difficult. So things are cyclical. They take some time to correct, but we'll probably see a more early stage entrepreneurs having a more difficult time finding money for their money-losing companies before they can get to the guy with the $5 billion sitting next to me. I asked him if he brought his checkbook, and he didn't. So,
Michael, as a follow-on question to that, in the mezz space, does size matter in terms of the interest that you have in the mezz space?
Yeah, I think if forgetting about fund size, so we have a fund that is 500 million, so that just creates a natural size thing. But I would say, and maybe I don't think I'm disagreeing with Fred, I think he'd ultimately agree with this, there's certain stability when you get, pick a number above 15, 20 million of EBITDA that I think all of us as lenders would prefer. Again, with the smaller fund that we had, everything we did was under 5 million, but there's clearly more go-away risk generally with companies of that size. So there is a premium, I think, in terms of again, 15, 20 million of EBITDA, the access to capital, I think, whether it's with a private equity firm or as a standalone, opens up substantially, and the cost of capital declines.
Fred, there's been an awful lot of talk in the news just about, in terms of regulatory issues making it more difficult for some of the companies out there. How have things like the Dodd-Frank and the Durbin amendments affected lending to companies? What's been the bank's effect in looking at those issues?
Well, we've only, I think, begun to see the beginning of that. A lot of the amendments and regulations that were adopted in that haven't been enacted yet. But internally within the bank, the scrutiny is far greater today than it was like 10 years ago. And I've been in the business for over 35 years, and we go through so much due diligence today. We're required to, and that's every bank. The requirements for us to underwrite a loan today, to look under the kimono, so to speak, is very, very robust. And the other thing is, the amount of documentation that it takes to get a deal done today. I'm dating myself, but we used to fill in the blanks on loan documents and type it in and then initial it if you had a change to it. And documentation is very robust too. We are audited so much more frequently today, and our lending standards are basically made consistent from bank to bank now by the OCC, the FDIC, and the Treasury. They have a certain level of measures of expectations for us, and if there's any doubt, they want us to add to our loan loss reserves. So it's not necessarily more stringent requirements. The requirements aren't tougher. It's the due diligence and the attention to detail is far greater.
Thank you. Aaron, is one of the things, again, that John pointed out quite a bit was the tightening in the capital markets. So in looking at what you do, I mean, how has that tightening in capital markets, in particular probably the senior loan market, how's that impacted the price that you're willing to pay for potential new investments?
Yeah, it's definitely apparent in John's work. The traditional view of private equity is that you're going to have to write an equity check that's going to equate to about 33% of the capital structure, and you're going to be able to borrow the other 2/3. And that's changed quite a bit, I would say, since the financial crisis. Really today, in a standard deal, It's closer to 40 or even 50% of the capital is required from the equity sponsor. So really what we've done is focused on businesses that do a better job of converting their EBITDA to cash. And I'm sure that Fred and Mike, can agree with this approach, which is that for $1 of EBITDA, if you have more of that dollar available to support your credit, it's a better company in some way, shape, or form. And what I mean by that is that if you have a tax structure that's appropriate for the business, if you have working capital usage that's to a minimum as the company grows, and if you have a lower amount of CapEx, you're going to convert a higher percentage of that cash to be able to support the credit. And what that allows us to do is it allows us to take a $7 million EBITDA business as an example and pay for the business as if it was an $8, a $9, or a $10 million EBITDA business, because we're generating more free cash flow to support a credit. And what that does, it allows us to reduce the leverage quicker and create more equity value so we can keep our 25 to 30% return parameters.
Terrific. Let me do this. I know that we're getting close to the time here. Do we have any questions from the audience for the panel? Okay, what I'd like to do is, number one, I'd really like to thank, a nice round of applause for the panel. And these guys drove, one guy was on the field for 2 hours and 45 minutes.